Welcome to the series Infusion presented by National Bank. As we like to remind everybody, this series is about covering themes and giving entrepreneurs tools so that they can tackle specific business aspects of their startup. Today, we're covering Accounting 101, which is a very interesting subject, a subject that oftentimes is ignored by many entrepreneurs. And that is why we decided to cover it. And with us here today, we have Michael Bloom, who's Senior Manager at EY, has many experiences with startups, and is going to present to you guys all the wonderful tax benefits and accounting tips and tricks in Quebec and Canada. So, Michael, hi, how are you?
Hi, very good, thank you.
Before we get started, I just want to remind everybody that the presentation is going to last about 40 minutes. You can ask your questions at any time in the chat. If you're not feeling comfortable asking it on the spot, note it in the chat so that we know there are questions, and then we'll get to them at the end of the presentation. Michael also will potentially stop every once in a while to ask you guys if you have questions. So don't hesitate to ask them then. But I would urge you also to use the chat as some kind of a note-taking mechanism so that everybody knows. You can also get answers from your peers. So don't hesitate to let us know what the questions are. All right, without further ado, Michael, it's up to you now.
Okay, fantastic. Let me just share my screen here. Share screen. There you go. I think everything's on.
Yes,
I think
sir.
the slides are good. Great.
Good.
That's fantastic. Okay, so my name is Michael Bloom. I represent the EY. I've been around EY for 13 years. I did audit, tax, advisory, IT advisory in the past, and now I'm specializing in taxation for the past probably 8 years now. I work in a team that we call Private Client Services. So we really help entrepreneurs from the startup phase all the way up to the IPO phase and everything in between. And I specialize in tax, but I have a basically broad set of knowledge in that field. So anytime you have any specific questions to your business, to your startup, you could always stop me at any time. It makes the presentations more interesting. Usually, obviously, we had these in person, so it was a lot more interactive. So if we could get to that level again, it would be fun. We talked with the team, and normally we have an accounting and financial reporting presentation, and we have a tax presentation. They're both condensed to about 40 minutes each. So it's a lot of information, and we figured as a team, it's probably more value for you guys at this point to go through taxation, see a bit how it works. There could be another presentation on financial reporting later on, possibly as well for you guys. But if you have questions on reporting, audited financial statements, how that works, could go ahead and ask that too. So I'm going to start here talking about tax. So it's a French deck, but I guess Est-ce que je présente en anglais ou en français ou ça change rien? Qu'est-ce que vous aimez?
We have a mixed crowd, so ideally it would be in English, if you don't mind.
In English, okay.
Yeah.
The deck's in French, so
that's fine. I think people will be able to. Yeah.
Yeah. Okay. Great. So we're going to talk about some basic tax rates, like income splitting, sales tax. If you want to expand to the US, a lot of entrepreneurs often want to know how to split their capital gains exemption. So those are kind of the topics we're going to touch on today. The classic, the certainty, death and taxes. So that's the subject that we're going to touch on. So to give you guys some ideas, when you actually earn income from salary, at the presentation is more to show you the highest marginal rate. So let's say if somebody's earning over $200,000 in Quebec, your highest taxation rate is 53% on salary if you take it out. Other ways that you could take out money out of your company is generally through a dividend. So if you take out a non-eligible dividend, you can pay up to 47%. Well, that was last year's rates, 2021 rates, you're at 48. Or if you have an eligible dividend, you could take out money and pay personal tax at the 40% rate. The difference is you're able to pay out the eligible dividend if your company earned over high level over $500,000 of taxable income during the year. So then you could pay out lower rate dividends to yourself, or if you sell your company, you sell the shares of the company that you started, or you get capital gains rate, which is still 26% in Quebec. These are Quebec rates, by the way. So to give you also an idea on the tax brackets over here, depending on your level of income, your tax rate, this is a 53 that we're talking about, but if you take out salary, that's 100, less than $100,000, you're at more of a 37% overall tax rate. So the more money you make, the higher the rate goes up. Okay, but you only pay the higher rate on the portion that's over the certain amount. So bottom line, the more money that you guys make, the more that's left in your pocket, but the government just claws back or takes back more and more in taxes. Okay. One thing that's really advantageous is really to often incorporate a company as a startup instead of just running it as a sole practitioner. The reason why is you get a big tax deferral, because if you just operate as a sole practitioner, you earn income directly, while your tax rates start around 27% in Quebec, and they go up pretty high up to the 53%. If you earn money through a corporation, through an incorporation, well, your tax rate in Quebec could be as low as, well, since the budget date, it's 12.2% in Quebec on the first $500,000 of business income. So the advantage for you as a startup, as an entrepreneur, once you start making money, is because you're only paying 12% tax, 12.2% tax in Quebec. You're deferring a lot of taxation. You're not spending it personally, so you get to reinvest all this money in the business, and you could make your business grow faster. So there's a lot of incentives that the government put out there with the small business deduction rate to lower the corporate taxation rate, so you guys have more money to reinvest. So that's the basic principle, or the main advantage that you have by using a corporation on the taxation front. Okay. There's also last year's budget, the Quebec government also announced some reduction in FSS, some other additional costs. They moved up the brackets on which you get lower rates up to $7 million of payroll. Yeah. Yeah, maybe I'll skip that for now. Okay, what's very important for entrepreneurs and startups is a lot of I would assume in this group, most people already have an incorporated company, they're shareholders, they have a couple of partners, maybe they had some seed money at this point. Okay, but the issue that you see a lot is a lot of entrepreneurs treat their corporation as an alter ego. So then after it's a corporate money, it's my money, it's all the same. It's not the corporation is a distinct person. And when you take out money from the corporation, that usually generates a taxable event. It's either you're taking it out as a dividend, either you're advancing money to yourself, you're taking a loan, and if the loan is outstanding for over a year after the balance sheet date, after the year end, well, that amount is included back, gets added back in your income. So it's important to treat the business as a separate entity, having its own ledger, having its own bank account, and be aware that that anything you take out for personal use of the company will likely lead to taxation. Okay, so also the principle of business expenses, whatever the business deducts. Okay, you could deduct an expense if it was used to basically earn revenue. You're you're doing R&D, you're trying to sell your product, you're doing some advertising, some promotion. Well, that's all business deductible expenses. You have the company pay for a cottage for the weekend because you say, well, the CEO needs rest to recover. Well, that's not that's a non-deductible event, and you have to pay tax on it. It's basically a shareholder benefit. So just be very, very careful. Or it's like even on automobiles, sometimes you have company cars. Whatever personal use of the car is prorated by kilometer, that you also have to T4 yourself. You have to tax yourself on that too. And some expenses, which are basically meals and entertainment, all the time it's either only deductible at 50% within the corporation. So you have to be careful. Anything that you use personally or for personal benefit, and it's really not used in the business, could cause an issue. And the issue where you see it come up, it's everything's kind of okay until you get audited. Because what happens is you start your business, you don't have CRA or Revenue Quebec on your door day one. What's going to happen? They have generally 3 or 4 years to come audit you. So if you create a problem, you don't keep proper books and records, 4 years from now, you get audited, they're going to go back, look at 4 years, reassess you. Maybe you'll be hit with a personal tax bill later down the line. So it's very important to keep proper records during that time. Okay, if you if you provide an exchange of services with another corporation or another person, just because you don't sell your services for cash, it's still a taxable transaction that occurs at fair market value. So you have to be careful for that as well. Any questions so far? Okay. Okay. Also, very important to understand that when you have employees and you have to remit source deductions for those employees, or GST, QST. You have to realize that you're an agent of the government that's collecting their taxes. So if you actually don't remit the withholdings, you don't remit sales tax to the government as an officer at the corporation, you can be personally responsible. A lot of companies or entrepreneurs, they make a mistake. They need cash flow. They say, okay, well, I won't remit my sales tax right away. I won't remit the employee's deduction at source, or it leaves more cash in the company. But if you don't remit it, the government could go after you personally because you broke your basically fiduciary duty to the company, and you're personally responsible for those tax remittances. So generally we recommend just basically don't do it to generate cash flow. It's not your money, it's the government's money. Remit it. And if you want to reimburse yourself for let's say kilometers or expenses, or you have employees using their personal car for business purposes, on the first 5,000 kilometers, you could reimburse them 59 cents a kilometer, and that's tax-free. So that's generally can be an advantage. Make sure you have a log, make sure that the business reason's documented, but it's a simple way of doing things. So sometimes people say, oh, well, I'll pay your gas bill. Company pays the gas bill, well, that's taxable for the employee. Really the only way to avoid taxation on providing car benefits is reimbursing by kilometer, and that's not taxable for an employee. So that's generally the way you want to go, instead of going piecemeal and reimbursing certain expenses for employees. That's important to consider as well. Okay, due dates. Well, personal returns, probably everybody here knows, for April 30th. For corporations, 6 months after year end. Payment of tax, even if you have to file 6 months after year end, you have to pay tax within 3 months or 2 months after year end. So it's as an installment. So you have to estimate your tax bill and actually remit. If you have employees, you have to prepare your T4, your RL1, and the tax slips that you have to give to your employees by the 28th of February of each year. Okay, you may have corporate tax installments as well, and that's if you pay tax, it's based generally on the previous year tax bill as well. Okay, uh, in Canada also there's a principle called integration, is that ultimately a dollar earned through a corporation or through earned personally, after the money's taken out personally, spent personally, you're supposed to overall pay the same amount of tax and be indifferent. Okay, by not taking the money out personally within the corporation, like I mentioned before, you get a deferral. You pay a smaller tax rate, and you pay the rest of your tax when you take out the money out of your corp. Okay, so generally, salary compared to dividends, there's the integration in Canada is not entirely perfect. There's what we often call tax leakage, or a little cost of actually earning money through a corporation than just as a sole, well, as running the business personally. Over here, you can see that that $100,000 income earned by an individual, you get a small tax cost at the highest marginal rates than if you just earn the income personally, but you get that deferral that I was talking about. So you have a cost, but you're pushing back your taxes. You're paying the 39% later. So, which is generally a big advantage. Okay. Yeah. So yeah. So once you factor in FSS, dividends, uh, generally the difference between bonusing out or taking dividends, the calculation is often pretty indifferent. You get some particular cases when there's R&D, or when there's losses in the corporation, that overall it could be potentially more advantageous to take out dividends overall between the personal owner and the corporation. But that generally we look at on a one-on-one basis, but there could be calculations to be considered at that point. Okay. The big thing for you guys is often R&D credits or tax incentives when you're in the startup phase, and every dollar counts. So for between Quebec and federal and R&D, you could almost get up to 70% of your salary expenses back. So that's a huge incentive, and there's many other types of tax credits and incentives too. So sometimes for R&D, as an older manager, you want to claim your salary to obtain R&D credits, but you can't necessarily afford to pay yourself a salary in the first place to get the credits. But what can be done as an owner manager is that you declare yourself a salary. Okay, let's say 40, 50, 60 grand, whatever you can. You have to, your cost would be the tax withholdings. So let's say on a $60,000 salary, you have to remit 15,000 a year to the government in income tax withholdings. But instead of actually paying out the $45,000 to yourself because you want to reinvest in the business, accounting wise, you just re-advance that $45,000 to the company. So now on that $60,000 salary, you went to claim a federal tax credit of 35% on that. You remitted a small portion in DASs, and then after you created this advance with your corporation. So in the end, uh, as an owner operator that's actually performing some R&D within their business, you could actually be cash flow positive. You have no direct costs. Your business corporation remits your personal taxes. You don't have any money in your pocket though, but at least you have more money to reinvest in your business that way. So that's something also to consider if your company has R&D projects. Okay, any questions so far from anybody here? Another practical thing that you have from entrepreneurs, a lot of on the exit strategy later on is you have what you call a capital gains exemption. A capital gains exemption is basically when you sell shares of a company. That's a Canadian controlled private corporation, and the shares qualify on the first, well, by the time you sell off your business, the exemption will probably be close to $1 million. It was 883 for 2020. So that means on the first $1 million, you don't pay any tax on the sale of shares. Since it's paying 26% gains tax, you're paying zero. There's something that we call alternative minimum tax. You may have a minimum tax to pay, but generally you're exempt from tax on your first 883, or like I said, probably close to $1 million if you guys are successful in exit. The capital gains exemption can also be split with family members or other people as well through the use of a trust. So you have to be aware that you are giving a portion of your sale proceeds away to those people if you wish to share your exemptions between family members that way. But it is possible to do it. So a husband and wife that owns an incorporation could have double the exemption, or 883 times 2, and not pay tax on almost $2 million at that point in time. The trust or this system has to be set up normally before you have a big plus value in the corporation. So it's not something that 5 minutes before you sell off your shares of the company that you set up. Usually this is set up at least 2 years before a planned exit. Okay, because there's certain rules to respect to be able to do this. So generally this is all done 2 years before a planned exit of your corporation if you want to split the capital gains exemption. Okay, so to create a trust, there's a constituant, there's beneficiaries, there's trustees. So the constituent actually sets up the trust by contributing either a $20 bill or gold coin, and then after on your trust basically says, well, I have beneficiaries. So the beneficiaries would be yourself, maybe your wife, your kids. So when you actually sell off your shares, you could say, well, part of the gain I'm going to give to these people. And then after you have trustees, the trustees decide what happens with the trust assets. So you generally will be could be you, your wife as a trustee, and some third parties. And that's the type of system you would set up when you want to split the capital gains exemption. There's other uses for trusts as well, but the trust is a separate entity that would own shares of your business. So that's something you guys could think of later on as well. So yeah, so that's it. Skip that for now. Okay. Also, like a lot of entrepreneurs want to income split with family members as well. Income splitting, the advantage is basically in Canada on your first 220 odd $1,000 of income, you're not paying the highest rate, you're paying some kind of progressive rate. So if you share your income, if you have one person making $400,000 or two people making 200, you're actually going to save between $22,000 and $35,000 of tax a year, depending on which province you live at the highest rate. Okay, the government didn't really like this. They made changes to tax legislation back in 2018. So generally, if the person is not participating in the business actively, the income is that they would earn out of the business would generally be taxed at the highest rate. So there's a bunch of rules that could get complex, but if you have family members or if you're starting off the business with somebody and you want an income split, generally these people either have to participate in the business or they had to invest in the business, and the business is generating a reasonable return for them.
May I ask a question?
Sure.
So you're talking about over 18-year-olds. I assume that if they're under 18, you can't do it, or
well, you're taxed at the high. They also get because compared to the old rules, it didn't really change if you were under 18.
Gotcha.
So under 18, you're still taxed at the highest margin. So it's actually very penalizing. So if you have somebody that was making 165,000, that's not at their highest tax bracket, and then they want to split off $30,000-$40,000 to a kid, well, that got recharacterized and you get taxed at the highest rate. So it could actually be a disadvantage as well if the what they used to be called, this was the kiddie tax rules, but now it's just what now it's more totally taxed on split income.
Understood. And let's say the 17-year-old is actually working. Are they imposed at the highest bracket?
No, if they're actually working and it's legitimate and their salary is reasonable, because if you go back to one of your slides, as if the expense is reasonable. If you're paying the 17-year-old 100 grand a year to do the work of a secretary, well, the government could say, well, that deduction's denied, and you get into all. But if you pay them, like
Fair market value.
fair market value, and they're actually doing the work, it's not an issue.
Understood. Thank you very much.
Okay. Okay, so yeah, so there's between 18 and 24. They put in, like, contextually what the government put this in, because what was happening is generally kids between 18 and 24 in school. Okay, what business owners used to do, they used to pay them dividends. You could pay somebody a dividend of 40 grand a year and they paid zero tax. So while they were in school and not earning income, they were paying them dividends. Government didn't like that, said, okay, we're putting in these rules, especially that's the group that they wanted to catch, is that wealthy families, wealthy business owners that were paying their kids to 40 grand a year, not pay any tax, and while they had low income. When somebody is like making 80 grand a year, it's not really worth, like, it's still worth something, but the benefit of income splitting is greatly reduced when somebody is making a reasonable salary. Important topic also is sales tax. Okay, this especially for startups. If you started up your company and you're losing money at the beginning, the income tax side of things is kind of less important if you're just carrying forward a bunch of losses. But sales tax, as soon as you hit your first $30,000 of sale, it's important that you start collecting. You have to realize that some provinces also don't necessarily have GST or QST or HST, which are basically you charge tax and you claim back taxes on your expenses. So the system in BC has their own provincial tax system, which doesn't apply on everything. So if you start selling hard goods to BC, well, the sales tax implication could be very different than if you're selling in Quebec. So you just have to consider that also, where you're selling, where you're dropping goods. If you're selling services, you have to validate if there's any sales tax implications, and you have to start collecting and remitting sales tax as soon as you have $30,000 in sales. Okay, so that's something to consider as well. Yeah, so same thing that I was saying before, you're really acting as an agent of the government. It's not your money, the sales tax. So if you don't remit it, they could go after you personally as well, as an officer of the company. So it's the officers that are responsible. And that could be even the case if you're not even a shareholder, you're just coaching somebody, you're on the board of directors, you're an officer of the company, and the company is not remitting sales tax. You have to be careful for that too. It's really a director responsibility here. Sales tax usually you collect on where you ship the client. If you provide services, it's usually on the address on where you sign the contract. So if you provide services to somebody there in Ontario, likelihood it will be HST that you're going to have to charge if that's the address that was put on your contract. But that should be validated on a one-to-one basis, and like an app, all that, depending on where the actual person lives. A lot of times, if you're selling like on Apple Play and everything, you could say the marketplace could manage this for you, but it's all stuff that you should consider and be aware of, because again, 4 years down the road, if you didn't manage this properly, that's when you get audited, and having an auditor knock on your door for 4 years of back taxes really well, it's really bad. Usually there's interest, there's penalties. It's not something that you want to get into. For a smaller corporation, you could also go in the quick method of claiming your sales tax credits, which is it's basically a percentage of your sales you're actually allowed to claim back. So if you have very little actual expenses except for salaries, sometimes tech companies end up in that situation, and your yearly sales are under $400,000, you could actually uh, save a little uh, save a little bit of money on your sales tax remittances. You could create about maybe $5,000-6,000 of actual income if your sales are under the $400,000 level, and use the quick method of income tax accounting. So it can help a little bit, but sometimes it makes your life also accounting for sales tax remittances a bit simpler. Uh, it's basically the government says like you collect your 15% of tax in Quebec, but only remit 3.6. Well, this is 2019 rates, still similar today. Only remit 3.6 and 6.6 to us. So you get to keep the difference. So if your expenses are quite low and you don't have any sales tax to claim, you get to keep that differential. So it creates a little bit of cash flow in an early startup phase. So you have an actual example. If you use the quick method of accounting for your sales taxes, this particular example, the company actually pocketed $6,800 by using the quick method. So it's with low levels of income, low levels of revenue, under $400,000 in this case. It's something to consider. Also for sales tax, if you have sales under 1.5 million, it's annual reporting. If you have sales between 1.5 and $6 million, you're on quarterly remittances. And then after, if you have over $6 million of sales, you have to remit monthly. You could also produce sales tax reports monthly if you want. So if you're claiming back a lot of expenses all the time and you have no sales and you want the cash flow, if you basically put yourself on a monthly sales tax schedule, you get to claim your expenses every month. So that's an option if to create some cash flow. Let's see. Yeah, just for sales tax. Okay, what I would like to mention, because I've seen it a lot, even with bigger clients as they grow. It's for sales tax audits. They're very specific. They'll go look at the legislation is worded that that if the invoice doesn't respect certain criteria, they just don't accept it, and you can claim back the sales tax. So it's actually the name of the company, the address of the company has to be accurate, the GST, the QST numbers has to be accurate. So just be like super careful when you ask people to invoice you. Don't use your personal name. Make sure your invoices are under the correct name, because a sales tax auditor could just reject the invoice. So if you don't do that little part of your administration correctly on a sales tax audit, sometimes you could and you claimed over $10,000 of sales tax credits during the year, and you didn't just ask your vendors or retailers to invoice the right party or put the right name on the invoice. Revenue Quebec says, no, this is no good. Pay us back our tax plus interest. Okay, so it's very easy for Revenue Quebec to go and reject sales tax invoices under an audit. As for compared to income tax, if the expense is reasonable and you could show that it was used for business purpose, even if the invoice is not under the right name, you could still use it as a deduction. But sales tax works differently. It's very picky on the invoices. And again, you don't see this problem day one in your startup. You're going to see this problem 4 years from now when you get audited for the first time. And then after, if your accounting is really bad, you don't keep proper records, then you just bought yourself a permanent subscription to Revenue Quebec, because they're going to knock on your door every 4 years, because you did everything. It's all over the place. They found money. They're going to come back and check you all the time, every 2-3 years. So something usually you don't want, a situation you don't want to be in long term. Okay, so the sum withholding rates over here, generally, so payroll, RQAP, some extra employer costs on salaries that you would pay people. So if you're doing that R&D trick, that you're just remitting your payroll obligations and claiming some R&D on your salary, well, you also have to remit all the social charges as well. And okay. I guess any questions for now by anybody? This part?
I did have a question about the TPS TVQ.
Yeah.
Put it in the chat because I
Oh.
want to make sure I got it right.
I don't see the chat, so.
I see. So I'll read it.
Sure.
If I make my $30,000 on December 31st, 2020, I'll have to start charging TPS TVQ for 2021, correct?
Normally it's in the period, if I remember the rule correctly, because I'm not a sales tax expert, it's the period following your first $30,000. So I would have to, I could validate, but I'm pretty sure it's
So my question is actually, do I have to charge it for every dollar I make in 2021 or only on any amount exceeding $30,000?
No, on everything after. Once you're registered, you have to charge. As soon it could
Okay.
$30,000 or as soon as you have a sales tax number.
And as soon as I have a sales tax number, it's everything I make beyond that.
Yeah, so even if your sales go down to 15,000, as soon as you're registered, you always have to remit, and then you could always claim on the other end.
Good to know. Thank you very much.
So there's a lot of advantages if you just have a bunch of expenses and no sales. You could still register to claim back the sales tax. You don't have to have $30,000 to actually register. As for the specific time, I would. I'm sure it's written on. I'm sure you could get the exact time on the government website. But yeah, on your $30,000 sale, normally you have to start remitting in the next period or on the. Yeah, I would have to go double check.
Sous toute réserve, I looked it up yesterday, and it was $30,000 in the last year or last trimester, last quarter. Sorry.
Yeah, that sounds reasonable. Okay, so yeah, okay. The next question a lot of people get, okay, that I have to deal with a lot is when companies expand to the US. Okay, everybody at one point goes to the mostly the US or international. So so when you're carrying on a business in a foreign country, foreign jurisdiction, well, that foreign jurisdiction wants their share of their tax income or whatever revenues or net income you're generating in that other country. So for U.S. Purposes, what the concept is nexus. So if you legislation is getting updated for the new reality of everything being online, but generally nexus, if you go solicit, especially for the States, if you go solicit physically in the States, go see clients, sign contracts dated, located in the US, in the foreign country, there's definitely some kind of allocation to the US of the business. So if you have a Canco, you're sending salespeople down, you as the CFO or CEO are actually going down to the US, soliciting, getting clients, going to trade shows. Then after, well, what portion of the income that I earned on my Canadian business and that income is also taxable in the US, because you just create a nexus, and then after you have to go allocate the revenue. So you could also then if you actually have to pay taxes in the US, you could get a credit in Canada, but you're really exposing your Canadian business to the US because of that. So a lot of people, what they want to do, and for other legal reasons as well, they often you want to incorporate a subsidiary in the foreign country. So when you actually operate in that foreign jurisdiction, it's that subsidiary that you're engaging in that foreign country. The contracts you're signing are from that foreign entity, and the sales you're making flow through potentially that foreign entity. That foreign entity after there's a clean cutoff between your Canadian entity, US, or US entity in this case. If you get sued, well, it's the US entity getting sued, so it kind of creates a potential legal protection as well if your contracts are set up properly. So so that's something you have to consider when you sell in a foreign country. Same thing with sales tax. There's 52 states. sales tax in the US is not, there's no input tax system. It's actually like a pure cost. So if you sell to an end user, often more hardware than software, but if you're selling to an end user, that end user, it's if you're charging them 7% sales tax in the US, it's a pure cost to them. If you didn't collect it and remit it, and you should have, well, then you get if the sales tax was 7%, well, the company's on the hook for that 7% tax bill. You can't claim it. You can't claim any expenses on it. It's not an in and out. It's a pure cost in the system for your client or for yourself. There's reseller exceptions, but once the big usually issue for a startup, because nobody's really making money, there's no net income yet at the beginning, so it's not usually an income tax issue. The first issue you encounter selling overseas or outside of Canada is always VAT. It's always sales tax. So depending on which and every state has their own sales tax legislation. So depending on who you're selling to and where the location, where you're shipping your products, you usually come up with a matrix. You split up your sales by location of sales, and then after you go through a risk analysis. Okay, who am I selling to? Where should I be collecting sales tax? I have enough sales in the state. Do I have to do anything to make sure I'm not on a hook for future liability? And all this stuff is also important because most of you guys will want to be raising money at some point. Okay, so if you're raising $2-3 million of capital, if your product takes off, well, your investor generally, as a director, wants to make sure that their risk is covered on a compliance side. They're like, you're putting in $2-3 million and you're going to be a director of this corporation. You want to make sure that you don't have any hidden liabilities that could be popped up, that could pop up because sales tax wasn't managed properly in the jurisdiction, or in Canada or in another province. So all these things is super important to consider, especially in the context of a startup of raising capital. So even if the amounts are small, some entrepreneurs, we don't have time to take care of this properly, but then later down the road, as soon as you want to go through a capital raise, it creates big hurdles, big problems, and it also shows your attitude towards your risk management as well, which is not necessarily a good thing. So it's stuff you should consider while you're expanding internationally. So the US went through tax reform. Tax rates in the US are similar to in Canada. There's no really tax havens anymore. There's a concept called transfer pricing that when you're related parties, each government wants to make sure that you're leaving a reasonable amount of profit in their jurisdiction for the added value that you're providing in that jurisdiction. So sometimes there was planning in the past that people wanted to leave more profit up in Canada because our corporate tax rates were lower than the States, but now federally US it's 21 across the board, plus a couple of points for state tax. So you end up kind of at a very similar rate between Canada and the US. Canada is still lower if you're eligible for the small business deduction, but generally, by the time you're at expanding to the US, it's not that much of a deal breaker. But when you get into expanding, there's transfer pricing to consider. There's studies to be done to make sure that each jurisdiction is getting their share of the pie, and when you get audited, you're not creating a bunch of risk for your company. Okay, COVID measures that were passed that are ready. Yeah, so I added that in the past. So I think, what time is it? 11:46. I guess we could open up the floor to questions. So I touched on a bit. So what do you guys care about? What's keeping you up at night? Could be general, could be financial reporting. I'm here to help you guys with your concerns. So. Anybody?
I see that someone wrote in the chat, is there a sales tax to USA for online sales?
A lot of states now. Okay, there was a court case back 3-4 years ago already now called Wayfair, and a lot of states have thresholds for potentially, especially if it's goods and products, you'll likely have to start remitting after you hit certain thresholds of online sales. And it's on a state-by-state basis. Every state has its legislation, so it's really, you have to say, okay, I'm selling, I'm shipping X to the state. I'm selling there's so many users in the state. Is there some kind of local legislation that would create a possibility for me to have to remit sales tax to that state? So yes, it's something that should be looked at before I'm
Yeah. On our end, I think that like for this is Pascal from Real Motion, and definitely what happens, we have a product, and what we do is we try to sell to a distributor for this. This has to do not as much with corporate taxes, but sales taxes. So we sell to a distributor. And because what we do want to avoid is selling directly to client, or we want to figure out what the best strategy is, because we're finding that depending on I'd say most of our sales are in the States, but depending on which state we're in, we're dealing with different taxes, right? So we're just trying to figure out, I think that's in our next steps, and figuring out the strategy between when we sell directly to a distributor and they sell for us. So like that, we have a one channel of business, or sometimes when the client asks us to sell direct to them our product, we seem to hit that hurdle of having to deal with the fact that the different legislations or the different taxation levels of the different states and those different laws. How would we go about, I mean, instead of, being stuck in a case by case scenario and having something that's a little bit more, I'd say a better overarching strategy?
Well, generally, like what you mentioned is when you have a distributor, okay, generally what you'll have is a reseller certificate. So then after they manage the local sales tax.
Yeah.
Okay, if you're not the end user of the product, generally in the States there's no sales tax to charge. So that kind of solves your problem. But for most of our clients is once you start drop shipping, selling directly, you look at your sales levels, you manage it by state, and it's all a matter of risk. So if like you have like a one-off sale in one state for $1,000, okay, on s'entend, fine. But if you
don't
start
register, but whatever. Yeah.
Theoretically, you probably should. Like even if it's $5, but like nobody's going to care if it's $5 of sales tax. But if you're starting to sell like $5,000, $6,000, $7,000 a year in the state, well, you come up with a matrix, and we could help you with that. Say, okay, where are your main states? What are you selling? Is it taxable? And you want to at least manage that sales tax risk. And unfortunately every business has to do that. So a good practice is really at least have your accounting system or your sales have some kind of internal reporting information.
Mm-hmm.
Where you know what you're selling to who and what's the sales volume per state.
Yeah. That's already there. I think it's just figuring out, like, I think we have case scenarios where we're selling, and because there are so many states, and then we'll be dealing with that. So our product is, we're particular in the way that we're a startup, and not in the sense that we have already sales of our product, and so and now what we're trying to do is we're trying to take it out from the garage side of things and trying to scale it up, right? So now and since I've since I've been managing this more, it's more like figuring out, sometimes we'll have just one sale in one state, so we have to make that exception, and then the client will say, well, I want you to sell directly to me, I don't want to go through your distributor. So we have all these odd scenarios, but I'm trying to figure out what will be, but I think this will be a separate conversation where I'll have to figure out and sit down and see, like, this is the situations we're in, here are the main scenarios, there are 3 or 4, and just say, how do we treat each of these scenarios and what's our default to it? So I guess it'll be another forum than this one.
Well, we often have office hours, or we have one of my colleagues, JB Jean-Baptiste Kanji. That's what he does, is help people. You sit down and say, what's your main states? What's your volume? What does it look like? Can we get an exception? Did you hit the sales threshold? Because we do have matrices for the 52 states.
Mm-hmm. Yeah.
And you could say, okay, high level, okay, these states, I really have to go look at this point.
Okay.
But yeah, it's not fun. It's a pain. It's very taxing. Pardon the pun, but yeah.
Well, I mean, it's fine. It's just, I think when you find yourself in so many scenarios, what you want to do is you want to narrow them down, right? So when we go through distributor, you take away the headache, you take away, and you have one case scenario. But when we're dealing, let's say we had a sale in Dubai last year, and that was a bit of a headache because now we're in Dubai, right? Like, I mean, already we're in the Middle East, which makes it more complicated.
Yeah.
So I think it's more understanding what our so because it's happened that we did take a hit, and I want to avoid that in the future. So it's more having a better more robust strategy on that end. Okay, but I'll take that offline, and we can discuss.
Yeah, set something up, and we'll get I'll get our specialist to talk to you and consult, and then after we can see if we can help you out there.
That would be awesome.
Yeah,
well,
so you could reach out to me directly, or you could reach out to Nassim, or
I'll reach out to you directly, and you can point me in the right direction or transfer my email. I think that'll be the simplest.
I want to contact them. So a lot of the point that I mentioned, like for a lot of startups, it's sales tax, it's the payroll withholdings, and you guys, most of you won't really have income tax issues to deal with, because you only deal with that once you start making money. And since you're in startups, usually there's a ramp. So fantastic if some of you are making tons of profit already, great. But those are also conversations for one-off, and we're always open. Like, you have my email here, so you can just write to me. We'll set something up. We have a 30 minutes, an hour consultation. We'll set something up with you guys. We don't charge for that. For an initial consult.
I think there's that one, and then there's the shred, right? I think it's maximizing the shred. We're definitely in an R&D business from what we do, and right now we've just gone through 2.5 months of R&D on another project. So I'm just trying to figure out how I maximize this, because I want to make sure that we're finding all the. I mean, it's not money to be lost when you're building up, right? So you want to be able to get the best out of the product of that program. But that one seems to be the one that seems to be the cornerstone for a startup in terms of if you have a lot of R&D to get the cash flow.
Well, the cash flow for sure helps there. And that's the major one. That's the one that's been around forever. But for one of my clients, 3 weeks ago, like Quebec had they had offerings for AI projects by Investissement Québec. There was grants up to 140 grand for an AI project. So I helped one of my clients get that one. So we have guys that just do that, but there's tons of grants. There's multimedia credits, there's e-business credits. So sometimes there's a combination. And also sometimes what we do is set up, like, if you have American investors, or depending on who's on your cap table, sometimes you want to make sure that your Canadian corporation maintains your Canadian controlled private corporation status. So if you have Americans in there, like, some businesses, okay, an American wants to come to invest, but then the model's not, like, the business model doesn't work anymore because there's so much R&D, and if your credit rates will drop in half, or sometimes even to a quarter of the level as they were before, that could be another issue depending on your investor. So you have to be aware that R&D is also very dependent on your corporation status as well.
Yeah, there's a strategy to be had for sure.
Yeah, definitely. And then after, it can affect the exit. There's other considerations. Another consideration for R&D that I didn't touch on yet is your intellectual property. Because if you start having boxes a bit everywhere, like corporations, okay, and you have cross-border sales, and then after you start hiring 2 R&D guys in the States because they're working from home and they're software engineers.
Yeah.
Okay. Well, now they're working for maybe the U.S. box. You want to put them in the U.S. maybe because they want their U.S. payroll. They want to be working for an American company, and then it's okay. Well, the intellectual property that's being generated by these guys, I want it to be owned by a Canadian company or U.S. company, and then because that's a problem after when you want to sell your business and exit, or you have an external investor coming in. So all your intellectual property management at the startup phase is also super important to consider. Because once your business like takes off as a hockey stick,
Yeah.
and it's worth $100 million, and your IP's all over the place,
Yeah.
that's a total disaster to manage as well. Because moving IP from one country to another is a taxable event. So that's also something you guys should think about.
Yeah. We're definitely right there. You know, taking out the business from the garage, and the fact that we're doing a lot of sales in the States, like we're at that place where we have to make sure that we're looking ahead, so that we're not making those mistakes. That it's harder to centralize after that all that IP. You know, just doing the IP will be just having an IP package that's comprehensive, that puts the value to the company, and having all that is one exercise in itself.
And one other thing that maybe you guys also should consider is everything that's incentive stock options. Okay, everything that's around equity, especially in the global economy when you're hiring employees overseas, not working in the same countries. I had an issue with my client. They hired Canadians. Okay, everybody's working from Canada, but they hired U.S. persons because they're U.S. citizens. They had green cards, but they're up here in Montreal. And the guys, what they did, because you're 25, you're a software engineer, and the guy says, well, I'm giving you penny stock to come into the company. So the guy exercises, but the guy's American. As a Canadian, the taxation event is deferred to you sell the shares in a Canadian controlled private corporation. As an American, your taxable event is the date of the exercise. So now we have Americans that have $300,000 personal tax liabilities because the company is going great. So it's all stuff. Also, if you have cross-border issues, stock options, all that those are other issues that you have to consider. And are you giving away too much of the company? And at one point, you change your stock your stock plans from you give special treatment to a couple of founders, and you change your plan afterwards once you have like a critical mass and everything. So it's all stuff to also you guys should think about too.
Okay. Thanks. Greatly appreciated.
Any other questions? I don't know how much time we have, or
Yeah, we don't have any time left.
We're done. It's noon.
Minutes left, so it's just enough time to thank you everyone for joining us today. And thank you, Michael, for your time, for the presentation. It's really greatly appreciated. I certainly learned a lot. Well, I hope to see you again next week. Next week, we'll be covering going global, so how to sell internationally. Next week and the week after, they're workshops. They're actually interactive workshops. So we'll be using the breakout room function, and you'll get to meet other entrepreneurs in the room as well. So don't hesitate to join us. You'll learn a lot while having some networking opportunities. So thanks again, everyone, and I hope to see you all next week.
You're welcome.
Excellent.
And if you guys have questions, just email me, and we'll be there.
Will do. Thank you very much.